Thank you, Alan. Alan Kirth from Guarantee Mortgage. He came and spoke at our one of our lender panels last time, and he was graciously willing to put this panel together. Thought it would be very helpful because a lot of questions came up about HOA financing. So I'm going to go ahead and let Alan take it away. And thank you so much, Alan, for doing this.
Hey, no problem. First of all, I want to share with you, this is not really about trying to obtain your business from a condo or homeowner's perspective. It's really just about giving you information. And in fact, a lot of the speakers that we have here really won't be available to you directly in any way. For example, Melissa Nunez, which I'll introduce when she begins speaking, really. She's from American Pacific Mortgage, which is actually the parent company of Guarantee Mortgage. We're a DBA of American Pacific. So, but what she has is a unique perspective because she's working directly with selling loans to Fannie and Freddie, as well as our other aggregators, which could be Citibank, Chase, lender banks, whatever, that buy loans from mortgage bankers. So really, she has the perspective of what it takes to have a project be completely warrantable and saleable. And that's really what every lender out there is doing. You have to appreciate that the Fannie Freddie guidelines are the holy grail of what lenders look at and whether a project is warrantable, from conforming all the way up to jumbo, because most jumbo lenders are still using the Fannie Freddie warrantable project guidelines. And there's a little bit of a difference between Fannie and Freddie, not tremendously huge. So we're going to begin with Melissa, but then we're going to go to Aaron Lowe, who is completely unique because his source of lending, by the way, he is a wholesale rep. Again, you can't contact Eric directly for a loan, nor his company directly for a loan. But what you can do is contact Aaron and say, hey, who's a broker that you work with in my area? Because he can give you that. Or you can say to your broker, hey, make sure you get signed up with Coast to Coast, who Aaron is with. Because what they do is they do non-warrantable litigation condos and a lot more, but we'll find out in a little bit. But it is only Fannie Freddie. So it's going to be Fannie conforming and Fannie high balance, but competitive Fannie Freddie that's non-warrantable. So that's very, very unique. And then last, we're going to go to Julie Gregory. So Julie's, sorry, my 67-year-old brain just stopped for a heartbeat, who is with Newfi Wholesale. Again, a wholesale lender, but a lender that is unique in that they do non-QM. So what they're doing is they are pricing in risk. So it's not going to be tremendously competitive product. It's going to be product priced for risk, and specifically into the jumbo category that's non-warrantable, because they're going to look at projects on a case-by-case basis. She'll talk about that, as well as some of the other products that non-QM can accomplish in this market. What we're going to try and accomplish, with Melissa speaking, is we want to cover the types of litigation that cause issues for warrantable condos, what documentation is asked for if the HOA won't answer specific questions about reserves and deferred maintenance, what types of deferred maintenance will make a condo unwarrantable, warrantable reserve requirements and non-warrantable reserve requirements. Anyway, and you also asked about balcony inspection requirements and what's going to happen with that in 2024, actually 2025. So we're going to, and hopefully we'll give you some examples of things that can and can't be done. So again, we're going to begin with Melissa from American Pacific Mortgage. And a reminder again that Melissa can't be contacted directly, and we'll give you her contact information because she works for a mortgage banking entity. She is the go-to person for underwriting of all projects that come past her desk. She is the condo desk specialist. So she sees, I mean, we have what, over 200 branches at least, probably over 4,000 loan agents throughout the nation, just a ton of products, of different projects coming by her desk on a daily basis, and sees all the issues. So what she's going to begin with is taking you through what is warrantable and what qualifies, so you see a general picture of that.
Hi, my name is Melissa Nunez. As Alan said, I am the condo desk specialist at American Pacific Mortgage. I've been in the mortgage industry for over 30 years, doing condos for the last 6. And condos have definitely changed since January 2021. And there's a lot of big changes that Fannie and Freddie made and that they continue to make. So I'm hoping today that I can answer some of your questions, if not all. So I'm going to go ahead and share my screen. It's just a really quick, let's see if that works. There we go. Can everybody see that?
Yes.
Okay. So just has my name, title, who I'm with. Everybody's familiar with limited reviews, LTVs. Anything over these LTVs is considered a full review. Honestly, the only difference between a limited and a full review now that Fannie has changed their guides is a budget. Because even with the limited reviews, depending on what comes up on the questionnaire, say there's a special assessment, we're going to ask for financials, whether it be a balance sheet or an income and expense statement. So limited reviews have changed significantly since these changes have gone into effect. Back in the day, it was we could just do it with a questionnaire. I know some companies were doing it with just an appraisal. That's no longer how it works. We actually need a questionnaire. Full reviews, everyone's familiar with full reviews. Those basically work the same. There's some basic condo information on here. These are just basic Fannie Freddie guides that are on this list regarding your questionnaire. No more than 15% can be past due on that. 15% of the total units in the project can be more than 60 days past due on their HOA dues. Has to be, if you're doing an investment property, it has to have at least 50% owner occupancy. Projects in a non-super lien state that require more than 6 months past due assessments. In the event of foreclosure, that one you hardly ever see. Comes up every once in a while, but doesn't. There's states like Arizona that, Arizona, Hawaii, Florida. Is it Hawaii? I know Florida for sure is a super lien state where they can collect. But usually the CCNRs will state exactly how much the HOA can collect. Condotels, single entity ownership. No one can own more than 20%. Fannie, 25, Freddie. That's across the board. Litigation, construction defects must be 100% completed. The only time we allow, or Fannie and Freddie will allow, construction defect litigation is if the repairs are 100% completed and the HOA is only going back to recoup their funds. So the HOA's already paid for everything. They're just going to get their money. If they're suing a developer or a contractor saying they didn't do the work right and that they want them to come back and they want them to pay them and come back and do the work and that work is still outstanding, we cannot, there's no financing that can be done on it until the work is 100% completed. Personal injury, slip and falls, death, those have to be, we prefer that they be defended by the insurance company, because what happens is if they're not, if the insurance company comes back and says, we are not going to defend this claim, the HOA is liable for whatever is awarded, if any, whatever damages are awarded to the plaintiff, and it can't exceed 10% of what they have in the reserve. So if you have a small HOA and they have, let's say, $300,000, but this person's going after $500,000, can't do it, because that will take all their money and some. Mandatory fees. Mandatory fees are, let's say they have a third party. A mandatory fee is, guys, there's so many different examples, I'm sorry. Sometimes you'll see where the management company is like, okay, there's $150 and we charge that to every new unit owner that comes in. That's fine. That's okay. The mandatory membership fees that we're talking about is HOA owns this or the developer built this beautiful new resort or new project. In the CC&Rs, the developer said every single time, oh, that's transfer fees. Sorry, I'm getting so mixed up. Mandatory membership fees, common areas and amenities. HOA has to own everything. So if your project is on a golf resort and your unit owner has to become a member of the has to become a member or pay dues to the golf club to play, but that golf club is owned by a third party, can't do it. HOA has to pay everybody. You can't make the unit owner pay for amenities that's owned by somebody else. If the HOA owns it and you're making them pay, that's fine. But if somebody else owns an amenity and you are telling them you have to pay to use it, regardless what, and even if it's included in the HOA dues, I'll give you an example. I had one that was a project that was right next to a Wyndham resort. And what they did is the HOA bought 10 annual passes every year to play in this, to use this resort. The unit owners were not given the option to opt out, and it was included in their HOA dues. If the unit owners were not given the option to opt out, I don't even play golf, I don't want to go, I don't know why I need to pay for this, but the HOA came back and said, well, it doesn't matter. Some of your money is going to go towards these annual passes owned by, to play in a resort owned by Wyndham. Project was ineligible. Has the HOA been turned over to unit owners? This one gets a lot of people. Has to be turned over. Developer can't own it. It has to be turned over, or it's considered new construction. It's still eligible, but it's just reviewed differently regardless of LTV. Same thing, 100% completed, has to be 100% completed. All the units have to be done, or at least 90% of them, in order to do an established and not new construction, which is a full review regardless of LTV. Commercial property, projects can't have more than 35%. There's no 35% of the total square footage of the building or of the project itself. So if there's various buildings, the total square footage of the whole project cannot exceed 35%. Budget, 10% has to be a line item. There has to show a line item of 10% on every single budget, regardless of what they have in an outside source, which is at a bank account. They could have $1 million in a bank account, but if the budget doesn't show 10%, can't do a full review. They have to go limited. You have to lower your LTV. Special assessment, if it shows special assessment income, we're going to have to ask what that special assessment is from. Any loans, we need to know what those loans are for. And that all has to do with the new Fannie Freddie guides, the special assessment and the loans. Master policy, 100% guaranteed or extended replacement cost. Fidelity crime coverage has to be at least 3 months of the annual HOA income. That is only for full reviews. That does not apply to limiteds. Must confirm that the management companies, HOA, everybody that has access to the HOA money has to be covered by that fidelity policy. General liability is also a full review only. Ordinance and law coverage. That is a coverage that covers the cost of demolition, covers the cost of demolishing the building and clearing the work site, and covers the entire cost of repairing and reconstructing the portions of the buildings that have been damaged. That's required by Fannie and Freddie. Waiver of subrogation, that is a big one. This is one I was talking to Alan about yesterday. Waiver of subrogation is one that I find that everybody seems to run into problems with. This is a Fannie required endorsement. What waiver of subrogation is basically you have a unit owner, has a friend come over, they have a slip and fall, they sue the HOA. The HOA cannot come back to that unit owner and say, you are going to pay our deductible because this was your visitor. So Fannie requires that they have this coverage on their policies. Freddie doesn't. So this is only a Fannie requirement. And of course, you've got to show the number of units covered by the policy. So why did Fannie and Freddie update their guides? Everyone knows this is due to the collapse of the tower in Surfside, Florida. Residential buildings, aging infrastructure, and significant deferred maintenance. Why am I being asked for a 1076 addendum? The 1076 addendum, Fannie and Freddie redid the questionnaire. So now they've added questions to it regarding deferred maintenance. It's used to aid the reviewers in collecting information regarding deferred maintenance. If the branch is unable to provide a completed addendum, additional information and documentation may be requested, such as 3 to 6 months. We'll do 3 to 6 months of the most current HOA board meetings, and we ask for a reserve study. If the HOA or the management company is unwilling to complete those deferred maintenance questions, and they're unwilling to give minutes and a reserve study, guides say can't approve the project. So it's one or the other. They're either going to complete the questions or they're going to give the minutes and the reserve study. But I'm also finding, after doing this for over a year, that they're not always very forthcoming on the questionnaire and filling out these questions. Their questionnaire says there's no issues. Minutes say something different. Minutes say, oh, we have drywall on the beams, on the stairwell beams. The roofs need to be replaced. There's leaks. So I find myself asking for both because, as I've said, not always forthcoming with information. You find a lot of information on reserve studies and on minutes. Can I still use the limited review questionnaire? As of December 15th, Fannie and Freddie retired the limited review questionnaire. It no longer exists. There's one questionnaire for both review types. What is considered significant deferred maintenance and unsafe conditions? Project with full or partial evacuation of the building to complete repairs for more than 7 days. The project has deficiencies, defects, substantial damage, or deferred maintenance that are severe to affect the safety, soundness, structural integrity, and habitability of the improvements. The improvements need substantial repairs and rehabilitation. Impedes the safe and sound functioning of one or more of the major structural or mechanical elements, such as foundation, roof, load-bearing structures, electrical systems, HVAC, or plumbing. Fannie's even looking at, I've had conversations with Fannie, they're even looking at fire alarm systems. They want to know, are those systems, it says in your minutes that your systems need to be completed. Are they done? Why is Fannie concerned with special assessments? Because if the special assessments related to safety, soundness, structural integrity, or habitability, all repairs must be fully completed or the project is not eligible. Additionally, the lender is unable to determine that there is no adverse impact, the project is ineligible. The budget does not have the required 10% reserves. Can I use a reserve study? Fannie has suspended that. Freddie is still allow it. So if your budget, we talked about budgets earlier, if your budget doesn't have 10%, Freddie will let you use a reserve study as long as it shows that they're collecting what this reserve study has recommended. Fannie's 10% across the board, has to have 10%. I've included the links for these updates from the Fannie Freddie updates. The 1076 covers deferred maintenance versus preventive maintenance. So what is considered significant deferred maintenance? I explained that one in the last page. Repairs more than 7 days, deficiency, defects. So basically anything that's going to affect the structural the structural health of the building, decks, balconies, roofs, stairs, railings, anything that can cause any type of health and safety issue. Those are all considered deficiencies. Now, if there's a HOA that's saying we're going to replace the roof because it's about 20 years old and it's time to get it replaced, doesn't need it, we don't have any leaks, we don't have any issues, we just feel it's time, that's where the preventive maintenance kicks in. Then there's those HOAs that are older and like, well, we haven't had the money, we just really haven't done it because, you know, we haven't had there's big projects that need to be done. And now that the stairs are falling apart, we need to get it done. That's where the deferred maintenance kicks in. My favorite, SB 326, the balcony inspection bill. So June 15, 2015, 6 students were killed in Berkeley and 7 others were injured when the balcony they were on collapsed. So this resulted in the passage of California Senate Bill 326 on August 30th, 2019. This balcony law was designed to prevent future collapses by ensuring the structural stability of condominium decks, balconies, and walkways. So these inspections must be done no later than January 1st, 2025. I see now that a lot of these HOAs are already getting them done. Some of them are finding they have big issues. Others are finding that they're okay. They just need some resealing or resurfacing of their decks and their balconies. And others are finding the actual need, like there's actual structural issues. For those that have the actual structural issues, those have to be completed. So we will be asking if these inspections were done, we'll be asking for copies of the inspections to see what these inspectors have found. And if there's any critical repairs needed or severe issues, we will ask that those be done before we do any type of financing. But we're looking at all the recommended repairs on these inspections.
Thank you, Melissa. That's great. You know, I think what we want to point out is some of the things that she mentioned. By the way, with your questions, we're going to have those questions be answered afterwards when all of the people on the panel can kind of respond. So I think that'll be a little more beneficial to you. You can go ahead and take that down. Perfect. Thanks, Melissa. I think also what you want to kind of recognize is that, again, she's not talking from the perspective of a lender. She's talking from the perspective of a condo desk that would exist in every lender, with exceptions. You know, if a lender is a smaller lender, maybe they're doing $2-3 billion a year as a mortgage banker, selling their loans to aggregators and or Fannie Freddie, they're not going to have a condo desk person, probably. They may actually outsource that to a third party, and or the underwriter may try and take on those tasks themselves. You're going to find that they're going to be much more risk adverse. They're not going to take risks. A bigger company like American Pacific, Guaranteed Rate, Loan Depot, et cetera. These are large mortgage banking entities that can actually handle that kind of risk and look at it specifically based upon the risk. So as she talked about, and I want to point out that she also mentioned that, you know, maybe we can't do a certain budget issue because of the questionnaire and the full review. So how do you get rid of that? You decrease the loan to value, so it goes to a limited review. So there are solutions to getting from a full review to a limited review. I want to point that out. Anyway, now we're going to move on to Aaron Lowe. Now, Aaron is with a company called Coast to Coast Funding. And in fact, Aaron, why don't you go ahead and introduce yourself really quick and tell us who you're with, and I'm going to ask you some questions afterwards, okay?
All right, sounds good. Good morning, everybody. First of all, a very nice presentation by Melissa. She'll be a tough act to follow. I wish I could say I brought so much documentation along with me, but I didn't. But as Alan said, I'm Aaron Lowe. I'm from Coast to Coast Funding. I've been here for 15 years, and since 2010, I've done nothing but non-warrantable condos. So I would venture to say that I've probably been involved in more non-warrantable condo transactions than anybody in the state of California, at least. So, we are a wholesale lender. As Alan had mentioned, we lend on correspondent loan channels, and then those loans are later sold to some portfolio investors that we have. Many of the things that Melissa had pointed out as guidelines for warrantable condos are many of the same guidelines that we would follow. There's maybe one or two where we may be a little bit more lenient or more restrictive. She had mentioned new construction. She had mentioned that the project would have to just be complete and turned over to the HOA. In our case, this is one case where we would be more restrictive, and we would require 90% of the project to actually be sold. But the reason why I'm here today is to talk about the non-warrantable side. And the biggest category of that is litigation. I would say 80% of the transactions that I do are condos and litigation. And there, the guideline is very simple. We do all litigation. There's been 2 examples of projects I mentioned to Alan when we were talking last week of my, 13 years now of doing only non-warrantable condos. The only 2 projects that people have presented to me that we couldn't do. One you may be familiar because it's up in your guys' area in San Francisco, the Millennium Tower, the one that's leaning and sinking into the ground. So that's one we haven't been able to do on the litigation. And then in La Jolla and San Diego, there was an unfortunate circumstance where part of an HOA had collapsed down on the beach and had killed some people below on the beach. So those are the 2 types of litigation in 13 years I haven't been able to do. Probably the biggest limiting factor for you guys based on property values where you guys are is the loan amounts. We only do the high balance conforming loan limits. So our maximum loan amount is just over $1 million now for a condo. But besides that, we go high balance, 10% down payment for primary residence, 25% down for second home or investment properties. And everything other than that is basically Fannie and Freddie underwriting in terms of qualification, a few overlays on, where Fannie may allow for some manual underwrite issues. We would probably just kind of pass on those types of things. An example, border income or some of these kind of more obscure things that maybe Fannie Mae by guideline allows for, but makes them difficult to transact with. So I did mention, 80% of what I do is litigation. A growing portion of what we're doing is HOAs that do not have sufficient insurance. And there's no hard and set guidelines on what insurance is required for us. But I haven't had any deals turned down for inadequate insurance. If there's a master policy in place, we can pretty much say that we'll do it. That's a little bit more of a case-by-case basis compared to litigation, which we do across the board. So we're definitely seeing a big pickup on the insurance deals coming in because of the new guidelines that Melissa mentioned. So litigation, insurance, budget, it's another one for us. We do not need the 10% reserves budget. High investor concentration. So I believe Melissa can maybe correct me if I'm wrong. For an investment property, it needs to be more than 50% owner occupied, the condo project. And we don't have that limitation. So we can do high investor concentrate, or excuse me, high non-owner on investment properties as well. 10% one entity in the project is something we do case by case. particularly in smaller projects where, you know, 1 or 2 units makes more than 10% of the entire project. So we do have a lot of leeway. Where we won't have any leeway there is if the entity who owns the majority stake or more than 10% is the builder. So if, you know, if it's a smaller project, maybe up to 20, 30 units, and there's somebody who owns 5 or 6, and it's not the builder, that'd probably be something that we would do across the board. And rates for us, you know, we're really pretty close to regular conforming. We're not always right there, especially when you get into lower credit scores and high balance loan amounts. But people are usually pretty surprised. And even on occasion, I've had people call me and we're offering a better rate than where someone has been quoted previously. But that's, you know, not always the case, but we're always in the ballpark, 1/4 or 3/8% to rate. Trying to think of what are the other big questions I get are, and you know, I kind of think that's the meat and potatoes of what we do. Like I said, mostly litigation and those other issues. And there are some few other ones that we can make some case by case ones, but you know, definitely get in touch with myself, and I can refer you to a broker, and we can, you know, take a look at those other issues case by case. But I think what you'll find most for us is litigation and insurance and budget kind of things.
And I think you'll find this a bit interesting that, you know, when we talked about deficiencies, when Melissa talked about, you know, finding those deficiencies and when something can't be financed because of construction deficiencies, you don't really see them, do you?
We don't. So usually where there's
very important.
Yeah, we don't. So like a lot of people are, you know, people will get in touch and say, oh, you do litigation. Yeah, we land on all litigation. And, you know, oh, can I send you the litigation paperwork to review? Sure, you can send it, but our underwriter's never going to look at it. So it doesn't really matter if, you know, you send it to us or not. And deferred maintenance and those kind of deficiencies aren't something that we see. And, you know, I mean, I guess if a place was falling apart and the appraiser, you know, made a big deal about it, that would be something that could come up. But it's not something I've come across, you know, ever really. So, you know, those kind of extreme cases where the building's kind of, you know, falling apart and has deferred maintenance to a point where it's unsafe. You know, I would say we could take a look at those case by case, but I think those are few and far between.
Have you turned any loans down for that lately?
I have not. No. And I actually just got one yesterday. Somebody inquired, and it's a balcony issue, strangely enough, because you had mentioned that new balcony requirement. I didn't even know about that. I didn't know that was something that was even in the pipeline. Since we don't do warrantable condos, that was not something that was on my radar. I did inquire with my underwriting manager about it, and he's like, hey, you know, it's kind of something we just have to look at case by case, because if it's not falling apart, it's not a problem for us. But we're not going to require that same inspection that they will need for a warrantable condo. So yeah, I called one yesterday. They said, oh yeah, they have this one, the unit, yes, the subject property unit balcony is under construction. And I said, hey, you know, it doesn't sound hopeful, but let me send the address and the information to the underwriter. And he said, no, let's do it. So, you know, sometimes there's those surprises to the good side.
But let me add that coast to coast is completely unique, everybody. I've been in the mortgage business 37 years, quite a long time, and a mortgage banker and broker for most of those years. There is no other broker source that does what he does. He is it, in California anyway. So does everybody know about them? No. I mean, there's a lot of small brokers that are, you know, have 3-4 man offices, and they just don't have a huge array of broker sources because they can't feed them enough business. to be able to have those sources. So, but larger companies that do broker banking are going to have an Aaron Lowe and a Coast to Coast specifically in their portfolio of, wholesale relationships. Now, that's what we call it. We call it a wholesale relationship. You have to be approved. So you have to submit, a broker has to submit documentation to Coast, get approved before you can give them a loan. So that's why I'm saying you can either call Aaron and get somebody that is already approved in the area, or you can talk to your broker that you work with directly and say, hey, get approved with these guys just in case we come upon something that isn't warrantable. Basically, what you're hearing here is anything that is conforming, whether it be standard or high balance, that has a warrantable issue, they're going to be able to do. And let's move to Julie. Julie is with Newfi Wholesale. And again, they are a non-QM lender. So they'll be able to answer some of those jumbo loan issues that doesn't fit the conforming and doesn't fit in a warrantable scenario as well. Julie, take it away and tell us a little about yourself.
My name's Julie Gregory. I've been in the business for 40 years. Yikes. And done a plethora of different held roles. But now I'm an account executive with Newfi, and I won't take a ton of your time because I know we're running short. For us, a lot of our jumbos do follow Fannie Freddie, but we do have some that will allow for like investor concentration can be 70%, commercial can be 50%. Single entity can own 25%. So those are definitely different than Fannie Mae. We also we'll go below a 10% budget. So those are all good. We treat 2 to 4 unit condos more like a single family. There is no project review that needs to be done. In fact, I'm doing a loan right now. It's 3 units, and each owner owns 1.5 of the units. And we're just going to look at it like a single family. The other thing that we do that's unique, I don't know how many lenders do this, is we will lend on condo tells. So, we go up to 1.5 million loan amount. We do them on DSCR, which is the no income, no employment. And there's different requirements. So you'll want to reach out to Alan or your loan officer to, go over the specifics. But also I wanted to mention, we do a lot of exceptions here. So it's always worth asking your loan officer, or again, Alan, can you check and see if this can be done? Because we will do a lot of case-by-case exceptions. So for the most part, those are the big differences on our non-warrantable, and then our other products do follow Fannie Freddie. And this, the one that I just told you, all the little non-warrantable items, does have a jumbo loan amount with that.
Thank you, Julie. Also, would you also point out, but when she mentioned DSCR, what she's talking about, ladies and gentlemen, just similar to a commercial lender, how a commercial lender actually values a property is based upon solely the rent. DSCR means exactly that. They're not looking at the borrower. They're looking at an appraisal and the rent, and they'll actually go below 100%. So if your rents are, $10,000 a month, and your PITI is $11,000 a month, sake of argument, okay, that's okay.
Mm-hmm.
So to a certain degree, what do you go down to? What, like 0.75?
0.
Oh, really?
Mm-hmm.
So again, very many unique scenarios. They do bank statement programs where 12 months of bank statements are required, no tax returns. I have a borrower that I sent that I qualified with a $4,500 income self-employed construction guy. I sent them 12 months of bank statements. The income came back at $29,000 a month.
Greatest program.
It's amazing. So these are some very unique products that can be done by non-QM. So let's get to your questions, folks. Is there a percent funded you were looking for? You want to answer that, Melissa, from a warrantable perspective?
Yeah, there's really not a straight percentage that we're looking for. We just, if there's a reserve study, we're looking to see what the reserve study says. And we're looking to see if you have 120 units, you can't have $50,000 in the bank. There's really no set number that we're looking for.
Got it. And regarding balcony inspections, is there a certification that must be provided by each unit or complex? Oh, I was blocked by something, or the complex as a whole?
If there's the balcony inspections, we're looking at the balcony inspections, we're looking at the recommendations. And if the recommendations state that certain number of balconies have repairs, and we are looking for contractor certifications that these balcony repairs have been completed.
Note she said have been completed. They have to be done to be warrantable. So what if they're not? Aaron? You have to take yourself off mute, bud.
Just as I started talking, I realized, no, we don't have any requirement for the repairs to be started, agreed upon, paid for, anything like that.
I think a good segue from that last question is, so usually if buyers have to switch a loan broker, so the loan is falling apart, you're already in transaction, and then now we got to switch over to Aaron at Coast to Coast, how long does that usually take to be able to close?
Right now, currently, we're running about 20 to 25 days from the time we have a complete loan submission. So, I mean, if you've gotten pretty far into the transaction and everybody has everything, and the transition, like you mentioned, I think in your question, moving from one broker to another happens quickly. If that needs to happen, then, then maybe you can do a little bit better or a little bit on the faster side of things. But, right now, particularly, we're reviewing conditions and submissions within a couple of days. So the biggest factor is always how fast does the requested documentation take to get to us.
And let me say that in that scenario, what you have to appreciate, what you really need to know is that your client is qualified under standard qualifications for their income, et cetera. Because as long as they meet standard qualifications, for example, they've been through a DU or LP underwriting engine, you don't have an issue. So your issue becomes the project, and he's going to be able to do the project. So you just need to make the time. That's all there is to it. So that's where you can literally have some confidence.
That's definitely the case. I mean, just to be really clear, we won't do any, there's lots of types of non-warrantable condos that we cannot do. But what we can do is very well defined, and we know that without a question from day one. So if you say, hey, Aaron, we got litigation. Hey, Aaron, we got this problem, the other one. And even if it's something we do case by case, that'll be a consultation I can have with the underwriting manager in the morning, and we can say, yes, that's a project that we can do, or no, we can't. It's not going to be, let's take 2 weeks and submit the loan and then find out later. That's never the case.
So I think we've covered most of the questions. I also want to point out that the non-QM side, for example, Newfi is a portfolio lender as well. And that's kind of what you end up looking for a non-warrantable, and when we speak of non-warrantable and portfolio, you may also find that some of the banks that you work with will do a certain project already. Maybe they've already investigated it, they've seen the issue, they're a portfolio lender, so they're not really selling a loan. This would include Chase and Wells Fargo, by the way, but they're likely to be they're probably going to stick closer to the warrantable guidelines. They need to defend themselves and not be in that scenario unless it's something that really is an issue that they've been able to overcome already. So they'll know that. You can just tell them, do you do this project? They'll probably tell you right off the bat whether they can or can't.
And there was a question regarding, does Coast to Coast underwrite and fund their own loans? Because you're mentioning portfolio loans. So
yes, we do.
It's
all written and underwritten and funded in-house. And then we sell, they're sold off to an investor or servicer in 30 to 60 days, but all the underwriting decisions happen in-house.
So what he's saying is they actually already have, what we do is in the mortgage banking side, we sell closed loans, obviously, but they already have an investor that they sell those closed loans to, and they are more of a portfolio style investor. So they are the mortgage banker, but they have their investor already. They know who that investor is, and that's who they underwrite to. And the same thing is somewhat true of Newfi. Newfi actually is itself a portfolio lender. So their whole thing is pricing risk. So you're not going to find it to be, a 7% interest rate, with 0 points or a rebate kind of concept, but you might find it to be 7% at 1.5 points. So that product would exist. Or maybe you're more likely going to find it like 7.5, 7.75, somewhere in that category, but still a very reasonable rate for the kind of risk that you're going to see. And they're going to be able to look at your project, and it doesn't meet, the standard jumbo guidelines. They're going to be able to make that decision of whether or not some kind of risk that they would want to take on. So I think that's the very biggest point. Are there any other questions we missed?
Yeah, if you don't mind, just a little clarity. So, Melissa, you said you look for at least 10% of the income to go to reserves, but on the reserve study, you don't look for a specific percent funded. Is that correct?
In the reserve study, what we're looking for is how much the HOA has in their, the reserve study is going to tell me what this company has recommended that the HOA should have, because it goes by years. So in
That's right.
2023, if they say they should have 200,000 in reserves, I'm going to look at a balance sheet. And if the balance sheet says they have 60, I want to know why, if you were recommended to tap 200, because you have these recommended repairs coming up, what is going on with, did you do something and use this money? Was it used for something else? Or what are we doing to catch up and make sure that you have this funding available, for 2023? Maybe you may not have it all, but at least you're working on getting to where they're saying you should be. That's what we're looking. We're looking at, Fannie and Freddie say we have to look at the financial health of the project. And that's for full and limited reviews. They want us to look at the financial health because they're looking, hey, if something happens, roof falls in, roof caves in, stairs fall, deck falls, how are you going to fix it? How is you as an HOA going to fix it? Are you going to get a special are you going to need a special assessment? Or do you have the money to do it? The reserve study is telling you all these things are coming up. How are you as an HOA going to fund these repairs? Because some of them have the useful life that it's at 0 or at 2 or at 3. So you're going to have to fix them in the next couple of years. And this is going to cost you $500,000. But right now you got 60. How are you going to keep up to make sure that these repairs get done?
So if they show you that they've increased dues and increased the budget or how much going to reserves, you're somewhat comfortable.
Yes.
Okay.
Yes. Depending on how much they've increased it. Yes. We're also looking at deficits. If your balance says you have a deficit, why do you have a deficit? What have you been doing? What's going on? They're looking at everything right now. And we're looking at everything because Fannie and Freddie want us to look at all their financials.
No, and that's better for the buyer as well, because otherwise there's going to be consequences, and those numbers are difficult to understand sometimes.
Yeah, and what we're also seeing, by the way, from Jackie Berry as an example, when she talks to an HOA, she's going to recommend they don't answer those questions. And that's what we're seeing on questionnaires. Yeah. We're seeing that our management is telling us not to answer these questions. And of course, that's the scenario that then requires providing the minutes of the last 3 to 6 months. And that's what Melissa's talking about, where she's going to go look through those minutes and start making decisions about, well, how well prepared are they to be able to meet this? Now, most of the time, got to tell you, providing 3 to 6 months, it's not a problem at all. Everything's covered. It's only a problem when it is.
Yep. So thank you very much, and really appreciate your time today. And we'll probably be in touch. You'll be hearing from different people along the way.
Thank you.
Okay. Thank you.
Awesome.
Have a great week.
Thanks.
Thank you all for being here. My panelists, you guys were awesome. So
you guys were
really
great. Thank you very much.
My pleasure. Look forward to hearing from you and maybe being back some other time.